Hello and welcome. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled, So You Want to Form an MSR Fund, Issues and Considerations. My name is John Van Gorp and I am a partner in Mayor Brown's Chicago and New York offices. My practice focuses on mortgage finance. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today are Larry Platt, Hawker Goodmanson, Krista Cooley, Lauren Pryor, Claire Reagan, and Eric Edwardson. Larry is a partner in our Washington, D.C. office. He concentrates his practice on a range of matters relating to real estate finance, mortgage banking, and consumer finance in both the primary and secondary markets. Hawker is a partner in our Chicago office. Hawker's practice is concentrated on financing transactions for residential real estate related assets, including mortgage loans, mortgage servicing rights, and servicing advances, utilizing a variety of arrangements and structures. Krista is a partner in our Washington office and is the head of our licensing practice. Krista concentrates her practice on matters related to consumer financial products and services and represents clients in federal and state licensing, regulatory compliance, and enforcement matters. Lauren is a partner in our Washington, D.C. office as well. She is also co-head of our financial institutions M&A group. She focuses on M&A in the financial services industry, frequently representing depository institutions, financial sponsors, mortgage companies, and investment funds. Claire is a partner in our Chicago office. She focuses on private investment funds and joint ventures. Claire regularly represents institutional investors making investments in private equity funds, hedge funds, managed accounts, and other alternative investment. She has broad experience representing sponsors in the formation and structuring of private equity and hedge funds. And finally is Eric, who is also a partner in our Washington, D.C. office. He has spent over 20 years representing residential mortgage banking clients in transactional and regulatory matters, with a specific concentration in transactions involving servicing rights and the servicing of mortgage loans. With those brief introductions, we will now begin today's discussion, which I will start. Residential mortgage loan origination volumes have been through the roof this year. Despite COVID-19 conditions, generationally low interest rates have created an unprecedented refinancing boom. At the same time, there has been a migration from the cities to suburbs, and as a result, financing for new home purchasers has been brisk as well. This is happening against a backdrop of the mortgage market moving away from traditional banks since the subprime crisis of 2008. The new mortgage market is supported by non-bank mortgage originators and servicers who lack the same access to capital and liquidity as traditional banks. To continue growing, these entities have had to be creative about their capital sources. Several are in the public market seeking to raise additional equity to support growth. Another trend we've seen is non-bank owners of mortgage servicing rights sponsoring or seeking asset-specific alternative private capital vehicles to fund their building portfolio of mortgage servicing assets. Unlike the originate-to-distribute models for mortgage loan production, mortgage servicing rights cannot be easily created and sold to investors. This is because the obligation to service the underlying loans cannot be separated from the financial aspects of the mortgage servicing rights. Therefore, the owner of the mortgage servicing right must also service the loans and be an entity licensed or approved to own the mortgage servicing rights. Fortunately, through creative thinking and structuring, we've been able to develop structures that enable non-bank, non-servicer, alternative capital sources to participate in the economics of mortgage servicing rights. During today's presentation, we will take you through all the phases of structuring a private capital vehicle that can invest in mortgage servicing rights. We are going to start with the licensing and regulatory approvals, which we believe to be one of the most significant hurdles to overcome. We'll move forward with a discussion of how to acquire MSRs into an MSR fund and finish with some ideas for optimizing MSR economics through leverage. We'll also spend some time talking about the various structures we've seen sponsors use to aggregate capital for this opportunity, including commingled pooled investment vehicles. I'm now going to turn the presentation over to Krista Cooley. She will take us through the basics of qualifying an entity to own mortgage servicing rights.
Thank you, John. So as John mentioned, when investing in mortgage servicing assets, a threshold consideration is ensuring that the entity holding the loans and the mortgage servicing rights and the entity that's engaged in the mortgage servicing activities all hold the required state licenses and federal approvals to engage in such activities. And each investing strategy in this space brings with it state licensing and other considerations that need to be evaluated at the outset of the investment. Now, if the goal of the investment is to be directly involved in mortgage servicing, then one needs to invest in a mortgage servicer or an entity that's authorized to purchase and hold residential mortgage loans and the associated mortgage servicing rights. Such entities can be created from the ground up or acquired as existing entities. And my colleagues are going to talk in more detail regarding some other considerations for each of these options. But from a licensing perspective, here are a few. First, a significant number of states require a license to purchase, acquire, or hold a residential mortgage loan, even if the purchaser or holder does not hold the servicing rights or engage in actual servicing activities. And some states also require a license to hold the mortgage servicing rights themselves, even if the actual servicing activities are outsourced to a third-party servicer. And additional licensing requirements can come into play for those that engage in the servicing activities. So if you're purchasing or holding loans or MSRs or engaging in servicing, licensing requirements generally are going to apply. To acquire such licenses, states have various requirements that entities must meet, and these include, among others, submitting audited financial statements, creating policies and procedures regarding the licensed activities, in-state office requirements, and designated qualified individuals who have the requisite industry experience to meet each of the state's specific requirements to engage in the licensed activities. The application process may also require that officers and directors complete personal disclosures that can be extensive and quite invasive. And depending on the jurisdiction, these personal disclosures may apply not just to the officers and directors of the licensed entities, but also could reach to officers and directors of the ultimate equitable owners. So once you get licensed, the licensed entity is then subject to a myriad of additional requirements, including some business practice requirements, which among others include books and records requirements, net worth requirements, quarterly and annual reporting and renewal requirements. And the licensed entity, of course, will also be subject to regulatory examinations and supervisions by the state regulator. So it's definitely an onerous process to get in and somewhat onerous process to maintain all of the required licenses. And the penalties for engaging in unlicensed activities, i.e. holding the loans or the MSRs without the required licenses at the state level, generally take around three forms. The first is civil money penalties or administrative fines. And these can be assessed on a per violation basis in some jurisdictions. So for example, for each loan purchased without a license, depending on how the penalty provision is written, that could equate to one violation per loan. And the regulators are often also authorized to obtain injunctive relief and issue cease and desist orders. So the penalties could be significant for engaging in this type of activity without the required licenses. And the second type of penalty is loan impairment or unenforceability. Now this penalty is a little less common for unlicensed purchasing than it is for unlicensed lending itself, but it is an available penalty in certain jurisdictions for unlicensed purchasing, including, for example, Massachusetts. And finally, we'll note that criminal penalties can also be authorized by the statutes, though in our experience, such penalties are rarely invoked for unlicensed activities. So that covers the state requirements. Now, if the entity wants to invest in mortgage servicing rights involving loans sold or securitized by the GSEs or loans in Ginnie Mae pools, the entity also needs to secure approvals from the GSEs and Ginnie Mae to engage in these activities. In order to do that, the entity needs to, among other things, provide audited financial statements to demonstrate compliance with the investor's minimum capital and liquidity requirements and demonstrate the requisite operating history. So given the significant hurdles to building an entity from scratch and obtaining all of the licenses and approvals to purchase and hold residential mortgage loans, either alone or with the MSRs, and potentially engage in actual mortgage servicing activities, depending on how you want to structure the investment, many entities will explore the acquisition of an existing entity that already holds the required licenses and or approvals. Now, this strategy comes with its own set of challenges. First, the entity will be subject to the change in control requirements at both the state and federal agency level. Depending on the jurisdiction, even the acquisition of non-voting stock or non-voting equity interests could trigger these requirements. And that depends somewhat on the extent of the entity's ability to exercise control over or directly manage the policies of the licensee. If you're making any changes to the existing entity's name as a result of the purchase or restructuring, that could also trigger filing or approval requirements. And while several jurisdictions require only advance notice of such changes in control, some important jurisdictions, such as New York and certain federal agencies, require prior approval. And that process can add several months to the transaction. So planning and timing of all of these considerations are crucial for a successful acquisition. So for all of these reasons, some of our clients have chosen to enter the space by acquiring a small licensee with some infrastructure, some operating history, a few vetted executives, but ultimately a small number of licenses. And that helps them get through the change in control process a little bit more smoothly, and then allows them to build out a more extensive network of licenses and federal approvals post-acquisition. Now, one final consideration I will note is that depending on how the proposed investment will be structured, one needs to consider whether the GSE or Ginnie Mae cross-default provisions will apply. So the Ginnie Mae Mortgage-Backed Securities Guide and both the Fannie Mae and Freddie Mac Seller Servicer Guides include cross-default provisions that are applicable to parties under common ownership or control. And what these provisions provide is that a default under the applicable guide or servicing agreement by one entity may be deemed to be a default with respect to another entity under common ownership or control. And the determination as to what constitutes common ownership or common control varies among Ginnie Mae and the GSEs. So it's really important to evaluate this issue if you're already invested in MSRs within the structure that you're looking to make additional investments through. And one final note on this topic is that in addition to the cross-default provisions set forth in the Ginnie Mae Guide, Ginnie Mae has in the past exercised its discretionary authority to limit or prohibit common ownership or control of multiple issuers with the same issuer approval type, regardless of whether or not the parties enter into a cross-default agreement. And also, while the Ginnie Mae Guide only requires 30 days advance notice of changes of ownership, many treat Ginnie Mae as a required approval based on their broad authority to review and approve these common ownership or control issues when multiple issuers with the same issuer approval type are involved. So I've covered a lot and just scratched the surface with that summary of requirements to hold MSRs, but at this point I'm going to turn it over to my partner Lauren to go over some additional considerations on how to invest in this asset.
Thanks, Krista. Yes, the build versus buy strategy is something that we've seen as a trend and a cycle in the mortgage industry for years. So contemplating an MSR fund, the business and legal teams often debate whether to build a licensed servicer from the ground up or buy an existing entity with licenses already intact, as Krista mentioned. Now, each approach has its pros and cons. And in recent years, trends favored buy strategies. We tended to see more acquisitions through M&A transactions than building a servicer through de novo licensing. And when you're acquiring an entity through a stock or equity transaction, certain licenses may be intact, existing operations may be already ongoing, and a management team would be in-house. So that would enable the entity that is acquiring the servicer to start the ramp-up process faster, and to get to full operations faster. That's typically the number one reason why we see a party who may favor a buy strategy rather than a build strategy. But in 2019 and the beginning of 2020, we saw an increased interest in building entities from the ground up. And in that case, a party starting an MSR fund would form an entity, bring in the management team, start operations, and start to acquire licenses over time, and eventually seeking approval from the federal agencies. So let's look at the advantages and disadvantages of each approach and how one would go about sourcing a target if you're interested in the buy strategy. So on the buy side, one of the first steps would be to consider engaging an investment banker for the purposes of looking at targets in the industry. You might find bankers who focus on particular size entities or particular servicers with particular focus. And so we find that that's one of the best ways for interested parties to source potential targets and to start the conversations with potential management teams. Now, as I mentioned, the number one reason why someone might look on the buy strategy side is the timing. So in a stock or equity acquisition of a servicer, it means that the MSR fund would have a licensed entity to utilize in a shorter time frame. As Krista mentioned, the time frame for change of control approvals would be applicable. In this case, we tend to think of the timing of a few months to identify the target, let's say 2 or 3 months to identify the target, and then 4 to 6 months for the negotiation process plus the change of control approval. As Krista also mentioned, if a New York license is involved, the time frame is going to be substantially longer. It may be 12 months or more for purposes of acquiring the change of control approval in New York. We also note that some state timelines have increased as a result of COVID work from home arrangements, and some states are operating with skeleton staff. For instance, we have one state we worked with this week, typically a 60-day approval process, and they're indicating to us that it may be 90 to 120 days. So as Krista also mentioned, we need to plan ahead and be aware that there may be some timing considerations that shift over time. But generally, timing is going to be faster on the buy side. And once closing occurs, the buyer has a fully operational company to deploy. But what's the downside? Well, we have to consider the legacy liabilities in a stock acquisition or an equity deal, because the buyer will acquire all of the assets and liabilities of the existing entity, subject to any indemnity or other limitations in the purchase agreement. Some key examples of legacy liabilities would be loan and MSR repurchase claims. One thing we look at in diligence in that respect is the repurchase log or the litigation log over time. We may consider whether there have been enforcement actions or third-party claims that are based on pre-closing servicing or compliance breaches, or failure to be properly licensed. Krista and her team would take a deep dive look at all of the licenses of the entity to make sure that they coincide with the servicing operations of the target. We can also take a look at general corporate claims, breach of contract, intellectual property, employment, and benefit matters. Now, employment claims can come about with misclassification of employees, but we tend to see that as more of a hot-button item on the origination side. Now, the ideal target would be a shell company or a company that has been operating with minimal capacity for a certain amount of time, because that can tend to mitigate some of the risk of legacy liabilities. But it's been difficult to find shell companies in recent years. And if we find one, sometimes it tends to be more on the origination side. Historically, we saw some smaller originators who would sell all of their assets to a bigger operator and then have a shell intact. But it's a little bit more difficult to find those targets on the servicing side. However, I would say there are some bankers who have contacts where there may be shells that are out there. So it's certainly something to consider. Another consideration is the cost between the buy and the build strategy. Now, the change of control and transaction costs are going to be heavier on the buy side because you do have those buy-side diligence expenses. You have the negotiation and the drafting expenses. The importance of diligence, of course, is that you could mitigate those legacy liability risks, but a diligence may be somewhat less for minority investments, but the overall cost could be somewhat more expensive on the buy side. Now, if we turn to the build approach, the biggest downside, again, may be just the timing to get operations. And as Krista mentioned, there are a number of requirements that must be put in place in order to obtain licenses. So although the advantages of starting a new company may be that there are no legacy liabilities, the buyer is going to be less concerned with the activities of a prior operator because they're starting the company from scratch. Plus, the legal and transaction costs may be lower, again, with the exception of certain licensing expenses. But the expenses are less overall than a buy-side deal with diligence and negotiations. Now, typically a new entity would be formed with minimal net worth requirements and capital to meet state and agency requirements. So remember that there's going to be ramp-up costs in addition to the transaction expenses because seed capital is going to have to be placed into the entity in order to facilitate that ramp-up period. And many of the state and agencies require that there is operations for a certain amount of time for a number of months before the approvals can be obtained. So also consider that a management team needs to be identified early and brought on board. Krista also touched on this point. Bringing the management team on board allows for faster approval processes and also allows for a smooth transition during that initial interim period before full ramp up to operations. As I said, in recent years, we saw fewer build strategies because the licensing time was so much longer than the change of control. I think we're in a period of flex now because of the COVID situation. There may be shorter time frames in some cases, and there may be longer. Last year, we saw that it seemed to be a shorter time frame for purposes of getting some of the agency approvals. But now, as I said, some of the states are taking longer on the change of control process. So I think we'd have to take a quick look at all of the states that are involved and keep in mind the time frame. And now I'd like to turn it over to my colleague Hawker for purposes of the alternative to licensing and GSE qualifications.
Thanks, Lauren. Hello, everyone. I'm Hawker Goodmanson. As we heard, acquiring or establishing a licensed servicer to be able to hold title to MSRs inside the fund can be costly and time-consuming, as well as potentially exposing the investors to certain regulatory requirements. Therefore, we wanted to highlight some possible methods that allow the fund to invest in MSRs without acquiring a licensed entity, whether permanently or as a temporary bridge while the captive servicer is put in place. All of these alternatives require a relationship with one or more third-party or affiliated servicers that agree to hold title to the MSRs for the benefit of the fund, which introduces various counterparty risks to the fund's investors, including the risk that the servicer goes bankrupt or is terminated as servicer by the applicable agency or the securitization trust. These are risks that can be difficult to ameliorate once the servicer hits hard time because moving MSRs is complicated and time-consuming. Therefore, it is important to set these arrangement up in a way that allows the exercise of remedies and the movement of the MSR as soon as possible if things are heading in the wrong direction. The first option I wanted to touch on is to invest in excess servicing rights issued by the third-party servicer. Excess servicing rights are fairly commonly used by servicers to obtain long-term or permanent financing on their MSRs and are essentially participation interests that are issued by the servicer in a portion of the MSR that can be secured by a lien on the related MSRs and are acknowledged by the applicable agency in the case of agency MSRs. A key limitation of excess servicing rights in the fund context is that, as a rule of thumb, the agencies will only acknowledge excess servicing rights for roughly half of the MSR strip, leaving the servicer with a significant portion of the MSR in excess of the cost of servicing. As a result, the remainder of the MSR economics needs to be transferred through some sort of unsecured contractual arrangement, such as preference stock or tracking stock in the servicer, credit-linked notes, or other derivative instruments, all of which represent an unsecured obligation of the servicer to make payments to the fund that essentially track the income received on the MSR after subtracting the cost of servicing, the servicer's fee, and the excess strip. And generally would also address the funding of other liabilities that are associated with the MSR, like servicing advances and if there are buyback obligations, et cetera, that belong to the fund. I also should mention that there are various ways of dealing with the funding of advances in these structures. One of which would be to have the fund acquire the servicing advances from the servicer and then finance them in a separate fund servicing advance facility of the type we'll touch on a little bit later in the presentation. Finally, I should note that some of these methods can be helpful to be used inside the fund, even if it has a captive servicer in place to help optimize the tax treatment of the investments, particularly for offshore and REIT investors. And I think that's kind of the outline of that topic, and I'll now turn it to Claire to talk about some consideration for setting up the fund itself.
Hi, Hocker. Thanks for that introduction. So as we've heard from Krista, Lauren, and Hocker, there's obviously a lot of legal and regulatory considerations that go into investing in MSRs. So if you're someone who knows these, how do you leverage your knowledge in that? Or if you're someone who wants to invest in these, how do you get into investing in them? And so setting up a fund accomplishes both of those objectives for both sides. The fund has an advantage over using just sort of a separate account structure because it allows us to have an entity in place that's managed by the RIA and allows the IRA to be the one that is interfacing with the underlying investments. And so the investor doesn't have to be holding those assets directly or interacting with the investments directly. And so the fund structure also has an advantage. It offers some limited liability protection for both the sponsor, who usually uses a special purpose entity as the entity that's managing the fund, and for the investor because the limited liability protections that are available under law by investing through a Delaware entity. So the big advantage for investors as well is that then you are getting both the protections under Delaware law, the fiduciary protections under Delaware law, as well as the fiduciary protections under by investing with a registered investment advisor under the SEC, who is going to have fiduciary obligations as well as be subject to the fiduciary and regulatory oversight of the SEC. And so then when we have a registered investment advisor in the structure, then some of the things we have to worry about are principal transactions. So if the manager of the fund has an affiliate that is either warehousing investments to be acquired eventually by the fund, or is serving just even as an intermediary for a moment in time when purchasing the underlying MSRs, we have to worry about principal transactions under the Advisors Act. And what does that mean? That means that we have to somehow build in consent for those principal transactions, which can be done either through, probably in this context, in sort of a batch consent type structure where we are building in parameters and saying, according to these parameters, if you acquire that, then we have consent for that transaction under the Advisors Act. You could also, go back each time to the investor and get specific consent, but based on the volume of underlying investments, generally the batch consent concept is going to work best. And then when we've got a registered investment advisor, if you're on the sponsor side, you're going to have to worry about making sure that any investments that you're allocating to this fund are made on a fair and equitable basis over time. So what does that mean? That doesn't mean that every investment has to be fair, but you have to have some process that when you looked, from a distance, that it looks as if it's fair and equitable. And usually that's accomplished by doing something either on a rotational basis or saying, whatever clients we're selling this to, each client's going to get a pro rata allocation of whatever MSRs come in. Or you can do it a different way as long as you've disclosed it to everyone affected. So you can tell somebody, well, this vehicle, they were in first, so they're going to get all all of the MSRs until we've invested up to X% of that, and then we're going to start sharing with you. So you just have to make sure that you have some process that will meet the standards that you're subject to under the Investment Advisors Act. So then what does it mean to have a fund, and what does it add to the structure in terms of fees? Obviously, there's underlying service fees and other things, but then having a fund in place, then there's going to be additional fees that are a result of having a fund. And so generally those are going to be a management fee, which is just a fee that's paid on a quarterly or monthly basis over time throughout the life of the fund, to sort of keep the lights on and keep going forward. And generally what we've seen in this space is that it's based on a percentage of invested capital. So as money comes in, then the fund will owe the investment manager a percentage of the money that they've put to work. But it doesn't have to be that way. It could be based on the capital commitment or, kind of whatever the parties come up with and think is fair. And then generally there's also going to be an incentive component to that. And that can either be structured as a traditional carried interest. So as money comes into the fund and goes back out to investors, then the manager can take a percentage of that as a traditional carried interest after the investor has hit certain performance returns, either an IRR or a preferred return on the money that's come back in. Or you can do it, we've seen it structured also as a percentage of the recapture rate exceeding a benchmark. And that can be negotiated between the investors on what they think is a fair incentive component to that. And so then when we get to the governance of this fund, really it doesn't look too much different from any other fund that investors are going to be investing in. And whether it's a commingled fund or if it's a fund of one, the terms are probably going to look a little bit different. But as always, they can be negotiated. And some of the key things that you're going to look at in terms of governance is, one is sort of investment restrictions. What can the manager do without having to come back to the investor or the investors? And those types of things are going to be pretty extensive. It's going to apply to both investments made by the vehicle and, what type of what prices can we buy things at, or who can we deal with without you having to come back and get investor consent each time. And then it will also deal with things at the fund level, which is, sort of governance rights. You can't let another investor into the fund without asking us, because we don't want to share profits after we've taken all the risk at the beginning. You can't amend the documents to change the terms without our consent, things that are typical in that space. And then expense is another big one. The margins on these can be kind of narrow, and so you don't want to have the manager having broad authority to kind of spend all the potential profits that are at the fund level. And so often investors will want to negotiate either some sort of annual cap or maybe a budget process where you're going to come and discuss, which works better, obviously. A budget process works better in a fund of one context rather than when you've got to get a bunch of diverse investors to agree on that. And then a couple of the other, just to sum up, final things that you might want to be thinking about when structuring a fund is sort of what reporting obligations is the manager going to have to tell the investors about the underlying investments and things going on. And then any MFN rights. So if I agree to invest with you either in a fund of one, or if I'm one investor in a commingled fund, what rights are you giving other people that might be more favorable than the rights you're going to give me? And I want to take a look at that and make sure that you're offering me the same rights. So, with that, I will turn it over to Eric. Thank you.
Thanks, Claire. This is Eric Edwards here. I'm going to speak to acquisitions of the servicing rights and a bit about using of subservicers for the performance of servicing. So the first question is, now that we've set all these things up, how do you get a hold of the servicing rights to invest in? And first, you can create them. If you have an origination platform, you've got the licensing and what you've acquired there in your buy or build strategy, as Kristen Lauren spoke about, as an origination platform. You can, of course, get the loans yourself, deliver them to investors on a servicing retained basis, and as a result, you have servicing rights. While the origination platform may afford you a source of predictability and control, you may prefer to focus your energies on the servicing rights, and that's a whole other line of business that you may not want to be in. So if you're acquiring servicing rights, there's two principal modes of transactions for acquisition of servicing rights. They're bulk, one-time purchases, or flow transactions, under which sellers sell you servicing rights over a period of time. Under a bulk transaction, the seller puts a specific portfolio out to bid, and the buyer can review data, perform due diligence on the loans, and look at what they'd like to buy and what the price they would pay for it. The structure of that transaction then usually has a number of steps. First, there's a sale date on which the economic transfer occurs and a significant amount of the purchase price is paid, followed by an interim servicing period during which the seller continues to perform the servicing on behalf of the buyer, and then ultimately a transfer date where there's another payment for advances that are outstanding, and a physical transfer of the servicing, including the transfer of data, documents, funds, and notices to borrowers. Note that in a bulk transaction, because it involves an existing portfolio, it may include loans with less desirable characteristics. For example, there may be loans in delinquency, foreclosure, bankruptcy, or currently quite a few loans that are in forbearances. Of course, all these loans cost more to service, and you don't get a servicing fee because the servicing fee is derived from the collections on the loans. So a bid may include those, or it may not, and you may have the opportunity to exclude those from a bulk purchase bid. But it's worth noting that on Ginnie Mae servicing purchases, in bulk deals, it's essentially unavoidable. And that's because in purchases of Ginnie Mae servicing rights, you have to purchase an entire portfolio, the portfolio of servicing rights associated with an entire pool. That is, if the originator had pooled a set of loans, when those servicing moves, it has to move as a group. So you essentially have to take loans that have these problems along with the good loans. So if you're not engaged in a bulk transaction, the other category for flow transactions, obviously the difference there is that you don't have a set portfolio that you can review and decide the pricing of. So you can't set it that way, but you can, of course, review what the historic production of a seller is and get a sense of what it might be coming from that particular seller. Moreover, you can add terms and limitations in your contract that would set the parameters of the servicing you should be delivered, including pricing characteristics using a pricing matrix that would make adjustments in order to incentivize and properly value the servicing coming in. But on the plus side, you won't have the problems with the delinquent loans, defaulted loans, and the like, because these are all going to be new originations, which will have been brand new newly pooled with the investors and should be quote unquote clean. So two types of flow transactions. One is called a mini bulk or forward bulk, and that essentially operates like the bulk transaction we mentioned before, with a sale date, interim servicing period, and a transfer date. But you're setting those over a period of time on various cycles, perhaps monthly on sales and quarterly on transfers. But there's another category of flow servicing right purchases called co-issue servicing purchases, and that's a little different. It's also called, in the Ginnie Mae context, a PIT transfer, or under Fannie Mae and Freddie Mac, concurrent transfers. And in these transactions, the seller gets a pre-approval from an investor that allows the seller to simultaneously deliver the servicing rights to a buyer at the same time as that loan is delivered to or pooled with a given investor. So it's attractive to a seller as a sort of a one-stop all-in transaction. It doesn't have to worry about multiple steps, interim servicing and the like. It can deliver the loan and the servicing out at the same time. But as a buyer, it presents an unusual circumstance in that to some extent, you don't know what you have until you actually have it. Because the seller is pooling and making decisions on what loans to pool and on a given day, on a day-to-day basis, and may not know literally till the day before they actually create a pool with an investor what loans are going to be in there. As a buyer, you don't have really any visibility into that set there until it's actually essentially dropped in your lap. One other note on purchases of servicing rights for Fannie Mae and Freddie Mac servicing in particular, and many people listening here will know this, but as a buyer of servicing rights, for Fannie Mae and Freddie Mac servicing rights, you assume liability for all of the origination and prior servicing of that loan, meaning that although you had nothing to do with it, if the originator, the seller of the servicing rights, or perhaps even a predecessor to that seller, had a problem in the origination of the loan that results in the investor seeking a repurchase of the loan or indemnification or make-whole payments, as the current servicer, you are responsible for those liabilities. Now, of course, you will have remedies back against the seller of the servicing rights under your servicing purchase agreement, which you want to be strong in order to be able to put those loans back or put those claims back to the seller of the servicing rights. But you also need to feel safe and feel some comfort that the sellers will actually be there, particularly in an somewhat unpredictable environment as we look over the next 5 years. It's certainly possible that some sellers may not actually be there when you go to use those remedies, and so counterparty diligence in a sales purchase agreements is always very important. With that, let me turn a bit to subservicing. Just like you may not have your own origination platform, you may feel it would be worthwhile to outsource the day-to-day servicing of the mortgage loans. And of course, there's a large number of subservicers out there to do that. Unlike the old infomercial, however, this is not a set it and forget it circumstance. You can't simply delegate out to that, turn away, and be a passive investor in the asset as a servicing rights owner. First, as the MSR owner, you continue to bear a significant economic burdens and risk associated with that servicing rights. Because this is the subservicers acting on an outsourced basis, it's simply paid a flat fee per loan per month. That fee would vary based on the condition of the loan. The delinquency, in fact, escalate rapidly as the loan became more delinquent within foreclosure or the like. But since that fee is owed to the subservicer for the work performed, and at the same time as the servicing rights owner, you're not collecting a servicing fee on that, there's a significant economic outlay associated as the loans grow more delinquent. In addition, as the loans grow more delinquent, there are advances to be made on those mortgage loans to the investors, principal and interest advances, also advances of taxes and insurance as those amounts go unpaid, and advances for various servicing costs associated with delinquent and defaulted loans. While a subservicer will administer that process for you by laying out that money from time to time as needed, they will be seeking at least a reimbursement, if not a pre-funding of those amounts as they are incurred, and so therefore as the servicing rights owner, you'll continue to carry that amount. On a related point, if you finance the advances, as Hocker will speak about momentarily, you may have to involve the financing structure with what's going on with the subservicer. In addition, the second point, and the reason you can't just set and forget it, is that there are significant rules, both from the investors and from regulators, including the CFPB, OCC, and state regulators, regarding the oversight of subservicers as one of many vendors that you may engage, and those are especially important in the context of consumer-facing activity. Any sort of examination from these regulators will include a review of your oversight practices, and so even a somewhat passive owner of servicing rights who engages a subservicer will need to have a set of experts internally to oversee and observe the activities, auditing the subservicers from time to time. In addition, for the fund structures we discussed, you may need to engage in a certain amount of oversight in order to meet your requirements as a manager of the investment. One last item, which is related to subservicers but not limited to them, it has to do with refinance risk and potential recapture there. When a loan pays off, of course, the owner of the loan gets paid the principal balance of the loan, but the MSR asset evaporates. So in a low interest rate environment as we are in now, the MSRs are vulnerable to refinance activity. So a smart MSR owner will undertake active efforts to engage in what they call refinance recapture. In other words, what you want to do is refinance these loans before somebody else can and retain the asset there. But of course, as we discussed, you may not have a origination platform with which to do that. So if your subservicer does have that platform, you may be able to leverage that capacity to engage in the refinance activity on your behalf and retain the subservicing that way. Now, the exact scope of how that can be structured is beyond this talk. There's numerous regulatory concerns, and moreover, the use of a subservicer is not the only way to attack that, but we wanted to point that out in this context. With that, I will turn it back over to Hawker to talk some more about financing arrangements.
Thanks, Eric. There are several ways to introduce leverage to our MSR fund to hopefully boost investors' return, and I wanted to touch on a couple of those. Say for the first one, all of these become more complicated in the case I was talking about earlier if the fund does not have a designated captive servicer, but we'll leave those details out of the discussion here. First, the fund can enter into subscription facilities secured by capital commitments of the investors. These are very common in the fund space generally and don't really depend on or vary depending on the type of investments in the funds. Second, the servicer can enter into MSR-backed facilities. Now, MSRs are generally tricky assets to finance because of the nature of the collateral. As we've heard today throughout the discussion, MSRs are intrinsically linked to the operational and financial well-being of the servicer. They're difficult to value, they're difficult to foreclose on, and they can evaporate if the servicer breaches its obligations under the servicing agreement. In addition, with respect to agency MSRs, an acknowledgement agreement with the applicable agency is generally required to pledge MSRs, which will clearly subordinate the rights of the lenders to the rights of the applicable agency to liquidate the MSRs and to be made whole from the proceeds thereof. Nevertheless, and despite these challenges, MSR-backed financings are fairly common and range from relatively simple bilateral secured credit agreements with a single bank to fairly complicated securitization like master structures which have emerged in the last couple of years, pursuant to which an SPV issuer issues various tranches of MSR-backed bond into the capital markets. Finally, servicing advances, excluding for the moment Ginnie advances, by contrast are significantly better collateral, although there are important and nuanced differences based on the type of advance that we're talking about. But compared to MSRs, their eventual repayment is relatively certain, and their right of reimbursement, at least to a great extent, survives the termination of the servicer under the related servicing agreement. The most common way to finance these, the servicing advances, is through bankruptcy remote master trust securitization structures that look a lot like the MSR structures that I was referencing a minute ago, but they can be set up as bilateral facilities with a single lender or a multi-tranche structure that also issue term notes to the capital markets. Ginnie Mae advances, by contrast, were until last year impossible to finance, partially due to the way in which Ginnie Mae advances are reimbursed, and partially because of Ginnie's peculiar status as government agencies and the restrictions on their operations, at least as perceived. However, recently Ginnie has begun acknowledging the financing of advances, but with the important limitation that they can only be achieved as part of the financing of the entire MSR. That's all. That concludes the leverage summary, and I now turn it over to Larry for some concluding comments. Larry?
Thanks, Hawker. So as you can see, investing in MSRs is not just about investing in an income stream. It's not like buying an IO strip, for example. Rather, if you're investing in MSRs, either directly or indirectly, you have to grapple with a complex set of relationships involving a regulated asset. One, for example, that we didn't even talk about is the relationship between a servicer and a mortgagor, which really goes to the fundamentals of servicing, but we didn't have time to talk about it. But then there's the servicer and the counterparty, the servicer and the insurer or guarantor, the servicer and the subservicer, the servicer and the MSR private investor or owner, the servicer and its regulators, the servicer and its finance sources, the MSR investor and its financing sources, the MSR investor and the GSEs and Ginnie Mae and the MSR investor and regulator. So you can see there's just a lot of pieces and moving parts. We could have spent an hour on each and every one of those. But all of these relationships ultimately impact returns on an MSR fund. So with that, I want to thank you for tuning in. A few brief reminders: you'll receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. And lastly, if you have any questions related to today's content, please email them to gfm@mayorbrown.com, gfm.mayorbrown.com. Thank you again for your participation, and this now concludes. You may disconnect. Thank you.